Chapter 6, Cost Behavior, Analysis and Use. Learning objectives. 1. Understand cost behavior. 2. Analyze and estimate costs. 3. Compute contribution margin and income. Types of cost behavior patterns. Behavior of cost within the relevant range. Cost, variable. In total, total variable cost changes as activity level changes. Per unit, variable cost per unit remains the same over wide ranges of activity. Fixed, in total, total fixed cost remains the same even when the activity level changes. Per unit, fixed cost per unit goes down as activity level goes up. Recall the summary of our cost behavior discussion from Chapter 2. Variable cost example. The total cost of meals is based on the number of guests. The cost per meal is constant. For example, $30 per meal. The activity base. A measure of the event causing the inoccurrence of a variable cost, also called a cost driver. Units produced, kilometers driven, labor hours, machine hours. Example of variable costs. Type of organization and costs that are normally variable with respect to volume of output. Merchandising company, cost of goods, merchandise sold. Manufacturing company, manufacturing costs, direct materials, and direct labor. Direct labor may or may not be variable in practice. See the on-the-job box at the beginning of this chapter. Also, see the discussion later in this chapter. Variable portion of manufacturing overhead. Indirect materials, lubricants, supplies. Both merchandising and manufacturing companies. Selling, general, and administrative costs. Commissions, clerical costs such as invoicing, shipping costs. Service organizations, supplies, travel, clerical. True variable versus step variable costs. True variable costs vary in direct proportion to changes in the level of activity. Step variable costs increase or decrease only in response to more than a unit change in the activity level. Direct materials, true variable cost. Waiters, step variable cost. The linearity assumption and the relevant range. A straight line closely approximates a curvy linear variable cost line within the relevant range. Fixed cost example. Total fixed cost of renting the building. Fixed costs remain constant in total dollar amount through wide ranges of activity. Per unit fixed cost of renting the building. Fixed costs decrease on a per unit basis as the activity level increases. Types of fixed costs. Committed. Long term, cannot be reduced in the short term. Examples: depreciation on buildings and equipment. Discretionary, may be altered in the short term by current managerial decisions. Examples: advertising and research and development. Trend toward fixed costs. Increased automation. Increase in salaried knowledge workers who are difficult to train and replace. Implications. Managers are more locked in with fewer decision alternatives. Planning becomes more crucial because fixed costs are difficult to change with current operating decisions. Labor cost, variable or fixed, depends on management's flexibility, depends on the employment terms and how employees are paid. If paid strictly on basis of output, it's variable. If paid weekly or monthly, independent of output, it's fixed. Fixed costs and relevant range, Part 1. Example. Office space is available at a rental rate of $30,000 per year in increments of 1,000 square meters. As the business grows, more space is rented, increasing the total cost. Fixed costs and relevant range, Part 2. Total cost doesn't change for a wide range of activity, and then jumps to a new higher cost for the next higher range of activity. Quick check. Which of the following statements about cost behavior are true? A. Fixed costs per unit vary with the level of activity. B. Variable costs per unit are constant within the relevant range. C. Total fixed costs are constant within the relevant range. Or D. Total variable costs are constant within the relevant range. Fixed costs and relevant range. How do fixed costs differ from a step variable cost? 1. Step variable costs can be adjusted more quickly. And 2. The width of the activity steps is much wider for the fixed cost. Mixed costs. A mixed cost has both fixed and variable components. Mixed costs. The total mixed cost line can be expressed as an equation, y equals a plus bx, where y equals the total mixed cost, a equals the total fixed cost, the vertical intercept of the line, b the variable cost per unit of activity, the slope of the line, and x the level of activity. Mixed costs. A mixed cost has both fixed and variable components. Slope equals variable cost per unit of activity. So the total mixed cost is y equals a plus bx. The analysis of mixed costs. Account analysis, engineering approach, high-low method, scatter graph method, least square regression method. Account analysis. Each account is classified as either variable or fixed based on the analyst's knowledge of how the account behaves. Engineering approach. Cost estimates are based on an evaluation of production methods and material, labor, and overhead requirements. Some mixed cost and activity level data. The month, activity volume, patient days, maintenance, cost incurred. The high-low method example, Part 1. Select the high level and low level of activity and use the related total mixed costs. Using these two levels of activity, compute 1. The variable cost per unit, 2. The fixed cost, and then 3. Express the costs in equation form, y equals a plus bx. The high-low method example, Part 2. Number 1, unit variable cost equals 2350 divided by 3,000 units equals 0.783 per unit. The high-low method example, Part 4. 2. Fixed cost equals total cost minus total variable cost. Fixed cost equals 9800 minus 6264 equals 3536. The high-low method example, Part 5. 3. Total cost equals fixed cost plus variable cost. Y equals A plus BX. Y equals 3536 plus 0.783x. Quick check. If sales salaries and commissions are 10,000 when 80,000 units are sold and 14,000 when 120,000 units are sold, what is the variable portion of sales salaries and commission? A. 0.08 per unit. B. 0.10 per unit. C. 0.12 per unit. D. 0.125 per unit. The answer is B. 0.010 per unit. If sales salaries and commissions are 10,000 when 80,000 units are sold and $14,000 when 120,000 units are sold, what is the fixed portion of sales salaries and commissions? A. 2,000, B. 4,000, C. 10,000, D. 12,000. The answer is A. 2,000. The scatter graph method, part 1. Plot the data points on a graph, total cost versus activity. Part 2. Draw a line through the data points with about an equal numbers of points above and below the line. Part 3. The slope of this line is the variable unit cost. Slope is the change in total cost for a 1 unit change in activity. Estimated fixed cost equals 10,000. Part 4. Slope equals change in cost divided by change in units. Vertical distance is the change in cost. Horizontal distance is the change in activity. Least squares regression method. Software can be used to fit a regression line through the data points. The cost analysis objective is the same. Y equals A plus BX. Least squares regression also provides a statistic called the adjusted R-square that is a measure of the goodness of fit of the regression line to the data points. Least squares regression method. R-square is the percentage of the variation in total cost explained by the activity. R-square for this relationship is near 100%, since the data points are very close to the regression line. Least squares regression method. Error, actual Y, estimated Y, regression line. Y equals A plus BX. Comparing the 3 methods. High-low, advantages. It is easy to understand and apply. Limitations. It utilizes only 2 points in the analysis. These could be abnormal observations. The cost formula may seriously misrepresent the true cost relationship that holds during normal periods. Scatter graph, advantages. It can be an extremely useful tool in the hands of an experienced analyst. Quirks in cost behavior due to strikes, bad weather, breakdowns, and so on become immediately apparent to the trained observer. Limitations. The line drawn is subjective. No 2 analysts who look at the same scatter graph are likely to draw exactly the same regression line. The cost estimates are not as precise as they are with other more sophisticated methods. Least squares regression. Advantages. It is an objective and precise approach. It uses all data points in the analysis. It mathematically fits the regression line. It provides other useful statistics like R-squared. Analysis can be done using computer software. The contribution margin format. An important use of the separation of costs into fixed and variable is that managers can use the information to compute the contribution margin. Contribution margin is the amount remaining once all the variable costs have been deducted from sales revenues. It provides managers with an income statement that clearly distinguishes between fixed and variable costs, great for planning and decision making. The contribution margin format. The contribution margin format emphasizes cost behavior. Contribution margin covers fixed costs and provides for income. We have sales revenue minus variable costs equals contribution margin minus fixed costs equals net income. The contribution margin format, traditional format. Sales minus cost of goods sold equals gross margin minus selling and administrative expenses, selling admin to get net operating income. Contribution margin format. Sales minus variable expenses like variable cost of goods sold, variable selling, variable administrative equals contribution margin. Minus fixed expenses like fixed selling and fixed administrative equals net operating income. For a manufacturing company, the cost of goods sold would include some variable costs, such as direct materials, direct labor, and variable overhead, and some fixed costs, such as fixed manufacturing overhead. Traditional format is used primarily for external reporting, and contribution margin format is used primarily by management. Chapter summary. A firm understanding of cost behavior is important for planning, decision-making, and reporting. Total variable costs change in proportion with changes in activity, where total fixed costs stay constant within a relevant range of activity. Total mixed costs, Y, can be expressed as Y equals A plus BX, where A represents fixed costs, B is the variable cost per unit, and X is the activity level. This cost equation can be determined through the use of the high-low method, the scatter graph method, or least squares regression method. Contribution margin is the amount of sales left to cover fixed costs and provide for operating income. The contribution margin income statement separates costs by behavior.